If you're following nationwide economic news, you may have seen that the Federal Reserve recently dropped interest rates. What this means is that the U.S. central bank is trying to encourage Americans to spend more by making it easier to borrow money. We can anticipate that the interest rates that banks and credit unions set on credit cards and other kinds of loans will drop, but average interest rates for savings accounts and certificates of deposit will go down as well. Today, we're going to look at what that means for you and what you can do to optimize your savings during a low interest rate environment. The September 2024 Fed meeting was actually the first time that the Fed decided to drop interest rates since 2020. The rate drop at that Fed meeting wasn't the largest decrease, but it signaled to consumers that the government wants the economy to course correct a bit away from expensive loans. Hopefully, lower interest rates will make it easier for consumers to afford the purchases they want to make. This could be great for people who want to buy a house or a car soon, since they don't want their monthly payments to be as expensive as they were when interest rates were higher. During the high rate environment of the past few years, interest rates on savings accounts and CDs were very high as well, some over 5%. As rates start to drop, it might be a bit painful to get less of a return on your savings. In times like this, it can be tempting to invest all your money instead. And if you have an excessive amount of savings, meaning that you have much more than you would need in an emergency fund, perhaps investing is something you can consider. But no matter what's going on in the economy, it's always a good idea to have cash set aside for an emergency fund and for savings goals that you want to accomplish in the near future. For an emergency fund, you'll need your cash to be liquid and easy to access, which is why a savings account is a great place for that money. If something unexpected happens, like a job loss or a major car repair, you won't have to jump through any hoops in order to use that money if it's in a savings account. On the other hand, if you have some cash outside of your emergency fund that you want to earn some guaranteed interest on during a certain length of time, a CD can be a great option. When interest rates are fluctuating, a CD can give you peace of mind because you'll know that the interest rate won't change during the term length of that CD. A drawback about CDs, however, is that you typically can't take money out of a CD without incurring a penalty before the CD matures, and you usually can't add more money once you've opened the CD. Therefore, having a savings account alongside a CD can be a great way to have both accessible money and money that's earning a guaranteed rate of return. If you don't already have a high-yield savings account or CD right now, or even if you do, you should take a look around at different banks to see what interest rates they offer. It's possible that these rates will go down in the not-too-distant future, but it's still good to compare what's available to see whether you can get a better interest rate. Even during low-rate environments, some banks and credit unions offer high-yield savings accounts and CDs that are going to have much higher interest rates than the national average. I'm Chanelle Bessette, and I'm a banking writer at NerdWallet. As interest rates continue to change, head to nerdwallet.com for articles, reviews, and roundups of the best products to consider in all areas of your financial life. And if you feel like you learned something today, hit like and subscribe.